An investment portfolio is a group of assets, a collection of assets rather, that will help you as an individual to attain specific investment objectives or even institutions. So it's a collection of assets that individuals or institutions hold in order to attain or achieve specific investment goals. In today's episode, we are going to be exploring investment portfolios. We are going to cover the different types of portfolios. We are also going to discuss how to build an investment portfolio. And I'm going to make sure that we simplify it, as we make it as simple as possible so that we all move at the same pace. My name is Belin. Please press the subscribe button if you haven't subscribed. For those who have subscribed, asante sana. I highly appreciate. Now, like I already said, an investment portfolio is a portfolio of different investments, different assets that an individual or an institution will hold in order to attain different investment objectives. Right? Awesome. Now, what are the types of investment portfolios? We are going to discuss four. The first one is a growth portfolio. These are assets that you hold to grow. They're most likely going to be the high risk assets. Why? There's a relationship between risk and return. So if you need a growth portfolio, you need to be able to have a high risk tolerance. This is why you have your shares. This is why you hold property for long term, for growth, for the property appreciation, right? This is a group of assets that you don't need to, that are not necessarily highly liquid. You don't need to liquidate them in the short run. You hold them for the long term objective. We also have the income portfolio. Income portfolio is a collection of assets that you hold specifically to earn income, passive income rather. This is the assets, the group of assets that you hold, especially when you're planning for retirement or when you're planning for work, for cash flows outside your 9 to 5 employment. That is things like the treasury bonds, the dividend stocks, income you earn from your circles, assets that will generate you income. Now, in this class of assets or in this portfolio, the land will be excluded, not unless it's land that is earning you income, that you're able to lease out to earn you income, or not unless it's property that earns you some rental income. So income portfolio is a collection of assets that enable you to earn some cash flow, to earn some income. We also have what we call a conservative portfolio. A conservative portfolio is a portfolio for people who are not risk takers, like how I used to be, right? So in this portfolio, you will not be having things like foreign exchange or forex investments. Why? Because it's highly volatile and it can easily make you lose sleep. This is an investment for low risk takers. This is where we now have our treasury bonds, money market funds, investment in fixed deposits in banks. Next, we have a balanced portfolio. A balanced portfolio, just like its name suggests, is a balance of all the other portfolios. You have assets that will grow, that will offer you the growth benefits, so you have the growth in it. You have assets that gives you cash flows, and you have assets that are conservative. Yeah, you have the conservative aspect in it. So it's a balance of everything put together. You have growth. The portfolio offers you growth. It offers you security, so you have the conservative in it, and it also offers you cash flow. So that ideally are the different types of portfolios. So you can pick a portfolio to specifically suit your investment objectives. In the next video, we'll be discussing about the different investment objectives and how to meet these investing objectives. So how best then can you come up with your investment portfolio? The first thing that you need to do, budgeting. You can never attain or achieve any investment objective if you're not budgeting. Whether you're in business or you're salaried, you always have to budget. Companies, Kenya itself budgets. A whole country budgets faithfully every year. Faithfully. Kenya budgets. Right? Every country budgets. So if a whole country with all the revenues can budget, how about you? How much more then should you be faithful with your budgeting? Without the budget, you will not know how much you're spending or where to cut out your expenditures. Without a budget, you will not know what your saving power is like or what your actual purchasing power is like. In other words, a budget would help to give purpose to your money. It directs your money to the right places. So you need to learn how to budget. You need to start budgeting. And without the budget, your money will always be haywire. Your finances will always be haywire. And if you want to grow a portfolio, you can grow a portfolio from investments. And you will not have the money to invest if you have spent everything. If you end up spending everything, you will be living paycheck to paycheck. So the first step to having an investment portfolio or to having your investment is budgeting. Right? Great. Now, once you have budgeted and you are able to allocate a portion of your finances or a portion of your income towards savings and towards investment, the next step is you need to have your emergency funds, a fully pledged emergency fund in place. An emergency fund is a type of savings. It's money that you keep aside to it's money that you keep aside to use in case of unforeseen expenditures. And that's ideally what emergency is. An emergency is something that you cannot foresee. So if you don't have your emergency fund in place and you had started investing, you are likely to liquidate that investment prematurely and use it towards your emergencies. If you don't have your emergency funds in place and you had started buying shares and you have an emergency, what are you going to do? You are likely to go to the NSE and sell your shares even though the prices may not be favorable for you. So you are likely to suffer capital losses. So it's very critical for you to have an emergency funds. The emergency funds will protect your investment in the event that you have any emergency. So number one, you need to budget so that you can allocate money for savings and for your investment. Number two, you need to have a fully funded emergency funds in place. A fully funded emergency fund will be emergency funds that would shoulder you at least 3 months worth of expenditure, your living expenditures, right? Next, you need to get started on your sinking funds. Remember, sinking funds is different from emergency funds. I told you emergency funds is a type of savings. So it needs to be liquid, yeah? It's money that you keep aside for unknown future expenditures. Now, sinking funds, on the other hand, is money you keep aside. It's a type of savings, but you keep aside with the intention of using it in the known future. You keep it aside for large known future expenditures. All right? So this is why you have your holiday sinking funds, you have your school fees, you save for your holidays, you save for your school fees, you save for your hospital visits. If it's a visit that like for instance, you're pregnant, you're expecting a baby, you're going to be spending for newborn shopping, you're going to be spending for your hospital bill if you don't have insurance. So you can set aside a sinking fund for that specific expense. You're planning on moving houses, you're planning on moving towns, you can set aside a sinking fund for that one. You're planning on buying a car or changing your car, you can set aside a sinking fund for that specific car. So for you to build your investment portfolio, you need to have Like I have told you, your budget in place, emergency funds in place, your sinking funds in place. These three things will protect your investment. If you don't have them, you are likely to liquidate, you are likely to disturb your investment. And some of these investment vehicles, by the way, they don't want unnecessary disturbances. They like peace. They like a peaceful environment. Pesa haipendi makelele. They like a peaceful environment. They like that once you have invested, you let it stay. Can you picture buying a property today and having to sell it 1 month down the line? Are you likely to make any money out of it? Of course not. Can you picture buying shares when the price is at 35 shillings and having to sell it when it's at 30 shillings? We know very well that shares, stock prices fluctuates. They increase and they drop. Can you picture buying forex or dollars when the exchange rate is at 125, and then shortly after, 1 week or 2 weeks later, you have to dispose those dollars? You are likely to run at a loss, right? So you need to have your budgeting, emergency funds, and sinking funds in place so that you are able to protect your investment from premature liquidation. Once you have them in place, you need to now set your investment goals. Your investment goal is what is going to determine which specific assets you are going to pick in your portfolio, in your investment portfolio, to achieve or attain that goal. Like I told you before, we have a growth portfolio, we have a conservative portfolio, we have an income portfolio or a cash flow portfolio, and we have a balanced portfolio. So you need to set your goals. Why do you want to invest? I get these questions, Berlin. Which is better? Can I take the treasury bills? Can I take the treasury bonds? I have 1 million in the bank. Which one can I take? Is it the bills or the bonds? And my first question to you is always, why do you want to invest? What is your why? Your why is going to determine your how. Why are you planning to invest? Are you protecting yourself from a possible job loss? Then you need conservative, growth, and cash flow. You need a balanced portfolio. Are you investing for your retirement? And you're investing for your retirement, how soon are you retiring? Are you in your 20s? Then it means that you have a longer duration to your retirement, so you can go for the high risk, for the growth portfolio, because then you have still some time to retirement to recover in case of any losses. Are you just 2 years to retirement, or have you just retired? Right? In the event that you have just retired, your risk tolerance then will be low because you don't have the luxury of time to recover from a possible loss on investment. So you need a conservative portfolio and a cash flow portfolio because you need to be using money. So you need to set your objectives. Are you planning? Are you investing so you are able to take your now 5-year-old child, transition your now 5-year-old child to university abroad? Okay, if that is the case, then you will need to invest specifically with that goal in mind. So you need to have an investment objective. Set your objectives, right? And then now, once you have set your objectives, it will be easy for you to pick up specific investment assets, specific investment vehicles that will match your investment objectives, that will answer your why you want to invest. Once you have set your objectives, you now need to assess your risk tolerance. What's risk tolerance? Risk tolerance is the level of loss you are willing to lose. How much would you be comfortable? Of course, no one is comfortable losing, but how much would you be okay losing without having to sink into depression or losing sleep? What's your risk tolerance level? Remember, there's a relationship between risk and return. The higher the risk, the higher the returns, and the lower the risk, the lower the returns. For instance, treasury bonds, MMFs, and bills are low risk. They rank low risk. Yeah, they are low risk investments, and so it follows that their level of returns are also equally very low. We have other investment vehicles which offer higher returns then that also means that they carry with them higher risk. These are investments like in forex trade, things like shares, investment in shares, crypto, and all other things. Yeah, this is why we have the special funds for those who are into unit trust or invest in unit trust. The unit trust, which are special funds, they carry with them higher risk because of their underlying assets, but they also offer you higher returns on your investments. So you need to ascertain what is your risk tolerance level. What amount would you not lose sleep over? For those who are into forex trading, they tell us only trade in money that you are willing to lose. Do not put in the amount that if you lost all of it, you'll lose sleep. Okay, so that is ideally what risk tolerance is like. How much would you be okay losing? How much, if you lost whatever you put in that investment vehicle, will you lose sleep? Will you lose sleep or will you sink into depression? Yeah, so you need to ascertain your risk tolerance level. Once you have ascertained your risk tolerance level, you can then now choose your asset allocation. Allocate your assets. The best allocation for people who have low risk tolerance level will be to start with the low risk assets and then diversify gradually to the high risk assets. For instance, you can start with investing in treasury bonds and then use the coupons that you receive from the treasury bonds to invest or now to buy shares. But this is for people who are low risk. If you are a risk taker, then you can jump into the risky ones. You can now jump into forex trading. You can jump into investment in shares, in stocks, which are the riskier assets, which also offer you higher returns. So once you have identified your risk tolerance, you can now pick the specific investment vehicles or asset classes that will mirror your investment objectives and that will also mirror your risk tolerance level. All right. Now, after having those steps in place, you have your budget, you've budgeted emergency funds in place, you have identified your objective, your sinking funds in place, you've identified your risk tolerance level, and you have picked your portfolio, your investment portfolio. You need to, on a regular basis, monitor your investment, monitor your wealth. These are your assets. Monitor your money, monitor your assets. The investment, is it working, or do you need to realign? Okay, you need to reassess. Is this helping you to attain your objective? Are you seeing it growing? Is the portfolio working for you? If it is not working for you, you can always re-strategize. For instance, you are holding these stocks, these specific shares, and for the past 3 or 4 years, one of the stocks that you're holding has been underperforming. You haven't been paid dividends, and there's no significant capital growth. It's okay for you to dispose that and buy another asset that pays you dividends, especially if you want to have an income portfolio or a balanced portfolio. All right? You need to assess your investments. If you've been investing in property, you have so many parcels of land. All right? And it's not helping you to achieve your objective, or you have attained that specific objective. You need to have your wealth value to be this amount, this value. You need to be maybe 50 million worth of assets, and you have attained that by buying different landed properties, which has already appreciated in value. So do you still want to continue with that objective, or then is it time for you now to come up with a different objective, which can now be seeing how this property can earn you some revenue? Reassess your investment portfolio and mirror them or reconcile it to your objective. It's okay for you to shift your objective. If initially you are working on an income objective and now you have bought your bonds, you have invested in stocks, you have your treasury bills, you have your MMF for your short-term objectives, and now you're in a position where every month you are able to you are able to receive certain amounts. You already have passive income that can sustain you. Is it now time for you to now start growing your wealth, to now taking the riskier investments that can help you to attain financial freedom or to retain your level of financial freedom? Is it now time to now start moving into investing in property so that you can grow your wealth? Remember, I told you bonds and bills are low risk investment. So, and I also told you that there's a relationship between risk and returns. The lower the risk, the lower the returns. The higher the risk, the higher the returns. Is it now time for you now to move on to riskier investments that will now offer you higher returns? Reassess your investment portfolio, and as you assess your investment portfolio, also mirror it to your investment objective. Finally, educate yourself. Stay informed. You need to be at par like this. Don't be investing in treasury bills, for instance, at a time when Berlin has been singing that rates are coming down, interest rates are coming down, interest rates are coming down, but you're still holding on to your portfolio in money market funds. Yeah? Be informed. Don't just hold your 50 million or 10 million or 500,000 shillings in your MMF if your objective was to attain financial freedom. Don't just hold your 10 million or whatever amount in your MMF if you're investing with an objective of earning constant passive income. All right? So you need to stay informed, stay afloat, be up to date with the local news, be up to date with financial news. Know what's going to affect your stocks. Know what's going to affect your property. Is there a road that is passing there? Are there demolitions that are going to happen? Did you buy a property in a prime area and there's slums coming up in the surroundings? What does that tell you? The value of your property is going to shrink, or the growth of the value of your property is going to be stunted. If slums are coming up in the area, is it then now time for you to dispose it and buy property in another prime location? All right? Be informed, be updated. So that's ideally is basically what an investment portfolio is and how you can come up with an investment portfolio that could help you to attain financial freedom. I told you in this channel, we all make wise investment decisions. Have you subscribed already? Please do, and let's meet on the next video.